So for those who tuned in last quarter, welcome back. For those that are new to this webinar, our goal is to keep this pretty casual. My name is Austin Hageman, and I am joined by Adam Armstrong. We are both advisors at Withum Wealth Management. Adam and I are going to have a fireside type discussion highlighting just a few of the many slides the firm's content committee has in our quarterly market update. And we want this to be more discussion based. So please feel free to ask questions using the question box on your screen. We will try to answer as many questions as we can, and if for whatever reason we can't get to a specific question, we will reach out to you after the webinar. I'll also add that we will be sending out a feedback form after the webinar. Please fill it out. You know, we'd love to hear your feedback, good or bad. You know, we're using it to try to always improve this. So we have viewers that are not clients. So a quick 30-second background on the firm. We are an independent registered investment advisor offering wealth advice and portfolio management solutions to wealthy individuals and institutions. We are a true fiduciary and sit outside of what I call commercialized Wall Street, in that we do not sell products or get paid to push a specific investment or any personal finance solution for that matter. Plain and simple, our clients pay us to offer quality wealth management advice, and we do not receive any other type of compensation on top of that, meaning we have no hidden agenda. We also have institutional investment reach, allowing us to offer clients a vast, unconflicted investment universe, as well as access to not just one, but multiple private banks. How did I do there, Adam? Did I miss anything?
I think let's dive in.
Let's dive in, cool. So we love showing this slide because it illustrates why we often shouldn't put too much of an emphasis on the news of the day. I mean, last quarter, we had both the Dow and the S&P 500 positive, with the S&P 500 up over 7%. And look at these two headlines near the middle here. The S&P 500 turns in worst week so far this year. Dow falls 700 points on interest rate concerns. Do you feel the fear they're trying to create? And I get it. Fear gets viewers, and more viewers translates to more revenue for these companies. Of course, the news would opt to say the market fell 700 points instead of saying it fell 2%. I mean, that is the math. The Dow is trading between 33 and 34,000 right now. 700 points translates to 2%. But a 2% fall doesn't create that emotional response that a 700-point drop may. And as investors, we need to be cognizant of this and not let our emotions get ahead of us when digesting news.
Yeah, there's a Fidelity study that comes to mind. I may have told you this, but if not, humor me. Fidelity has millions of accounts, brokerage accounts, so they can see what's invested in each of their accounts, and they can derive performance from all those accounts. And I think this was done in the mid-2000s. They wanted to figure out, was it something about an account owner that made them perform, you know, the best performing accounts do well? Was it anything that they could attribute to the person, be it their age or their gender, or, you know, whether they were a man or a woman? But they couldn't find anything except for one thing. Could you maybe guess what that is?
What's that?
So there was one consistent thing that led to better performance, and that was that the clients, the owners, were actually dead. They had passed away. So they physically couldn't make any changes to the portfolio or the assets, and those were the ones that performed the best. And I think that that study rings true here to what we're saying. Tune out the noise. If you're watching CNBC every day, just shut it off. It's going to be stressful at times. It's going to be really great at times, but that should not affect your investments.
I can see the book title now, Dead, an investment approach for success.
I'll co-write it.
Yeah. And that's you know, it's true. You know, and we need to understand that the news is part entertainment and it's part a reflection of the very recent past, whereas the stock market, on the other hand, attempts to price where the economy is going, not where it was today. And that's extremely important to keep in mind. So let's jump to public enemy number one, inflation. Adam, let me pass the torch to you here, and I'll flip forward to a slide.
Yeah, well, if we're talking about where the market's going and what the market is pricing in the future, maybe this isn't public enemy number one anymore. Inflation's dropping. We talked about this last time. The headline number was an even 5% year over year. So next month, we're expecting sub 5% inflation. Core is stickier and tends to follow the headline numbers, which include food and energy. You can see the blue line on this chart is dropping more. Eventually, we would expect this to be lower than it is actually lower now as of the March report, lower than core CPI, and we expect core CPI to follow suit. And both of these, in our view, like we said before, are still on track to be, sub 4% by the fall, hopefully sub 3% by the winter. Maybe not for the best reasons, which we'll get into, but if you flip to the monthly chart of CPI,
sure,
we've had a couple more data points since the last time we got together for this webinar, and you can see now since July, CPI has been annualizing 3.2%, far more normal. Okay, this is enough of a data set now to consider the trend is in our favor. Inflation is coming down, and you can see what's soon to be rolling off the data in April, May, and June. The next 3 months of inflation reports, if we continue at this trend, we're going to be dropping another probably 1 to 2% by the time we're into July again. So, we could easily be sub 4% at some point later this summer. And that's going to present problems for the economy if the Fed doesn't do anything, because the Fed is keeping their interest rates up at, now it's at 5%, right? And they're expected to hike one more time. So we could start to, the Fed is data dependent, so they look backwards in the rearview mirror. But if they're not using foresight here, this could start to get ugly for the economy in our view. Inflation would be coming down, but again, maybe not for the best reason.
Right, and we've really been in front of this, right? I remember last quarterly webinar, and certainly you look at our materials even prior to that, we've been pointing to this slide saying, if you cover the full 12-month period, right, inflation's running 5 to 6%, but when you focus on, the more updated months and you leave behind some of those bigger months of last year, you get to a more reasonable level.
Yeah, and what happened in between June and July? Well, that's when people really started to price in much more rate hikes, and interest rates started materially going higher. So, you can kind of connect the dots here in hindsight. Hindsight's 2020, but here we are, and we still think this trend is valid.
Right. Now, let me skip ahead a little bit here. The Fed keeps pointing to core service inflation being stubborn, right?
Yes. So they break out core CPI into goods versus services. Goods are things like, buying a new refrigerator, renovating your bathroom, right? Everyone did that when they were locked down in the COVID pandemic. We had these huge backlogs of, at the ports, right? Supply chains were all messed up for a long period of time. Everyone already bought their car, bought their refrigerator, renovated their house. So goods are not inflating as much. And that's because now, really since mid 2021, as you can see on this chart, the purple line is just continuing to go up and to the right. And this is the trend we think, the Fed has talked a lot about super core inflation, which takes out goods, it takes out rent as well. We think this is what they're focusing on more, which is the services inflation, and we're expecting that to start to go down. Again, maybe not for the best reason. So the Fed is hiking rates. They're not focused on making sure people's dishwashers stop inflating at 7% year over year. They're focused on making sure that really people stop spending as much. And now the spending patterns have changed from 2 years ago, as we can see in these inflation numbers.
And how does the Fed get core service inflation down?
Yeah, so they're raising rates, but they're looking for one thing to break. And about 6 months ago, people were really focused on wage growth. And while that's true, I think you can, if we flip to that slide, Austin, we can see that wage growth, which is the blue line here, has peaked. okay, towards the end of 2022, wage growth has been going down. And wage growth declining is a leading indicator for unemployment rate also rising several months later, okay? And ultimately, how do you get people to spend less? We need unemployment to go up. When would that happen? That would occur, sometime in a recession, okay? So this is kind of a dour situation to talk about, but we do think the Fed is trying to induce a recession to some degree. If you look at their GDP forecast for 2023, full well knowing that GDP in the first quarter was positive by 2 to 3%, they forecasted the whole year of 2023 GDP below 1%, which means they're expecting at some point in the back half of this year to have negative quarters of GDP, which we know would be a recession, okay? Especially while inflation's coming down. So really, ultimately, we think the Fed is just going to push the envelope, continue stepping on the gas in terms of hiking rates until they see something in the system break. Now, I don't want to tip our hand too much here. We're going to talk about the banking crisis later, but we think that could be starting to see some material job losses and unemployment rate rising. We've already seen job openings come down significantly. We've seen small business hiring intentions drop significantly over the coming months. Both of those things are leading indicators of unemployment rate going up in the near future as well.
Okay, so I guess let's talk about the yield curve, because this is really the Fed's tool in all of this, right? If I just pull my little marker up. So the green line down here, that is where interest rates were, the yield curve was about, a year ago, with the 1 month through 4 month yielding less than 1%. Last year, coming into this year, the Fed pushed rates up, close to 5%, right? This blue line on top, and then that's where it was pre-Silicon Valley Bank, the banking crisis, and then rates have come back down.
Yeah, so the Federal Reserve has control over what we call the overnight rate, or the short end, the far left of this chart, okay? So that's what the Fed can control. We all know that last year they were, had just hiked rates once at this point last year, their first 25 basis points above zero. Since then, they've hiked rates all the way up to 5%, which is exactly what we can see on the short end of this curve, okay? The market determines the longer end of this curve. That's the right side of the yield curve. What you want to see when the economy is doing well and there's confidence in the economy is a positive, we call it a positively sloping yield curve. That's the green line, where you start at the bottom left, lower rates on the short term, and you go up towards the right. That's what you want to see. And this is where banks make money. They lend out mortgages for 15 years, 30-year mortgages, right? So let's say in the green line example, you could have refinanced your mortgage this time last year, for 3.5%, but we all know we were getting 0% on our cash, okay? That's how banks make their money. They lend out at higher rates and they give to depositors at lower rates. The problem is now we're in an inverted yield curve where the short end of the yield curve on the left is higher than the longer term. So if the bank's going to issue, let's call it a 5.5% mortgage today, and they also have to pay depositors 5% interest on their cash or CDs, they're not really making any money. So the banks are not incentivized to lend, and this causes seizures in the credit market, which eventually will have, when there's less loan growth, there's less economic activity occurring, okay? And that's what can cause a recession. So this inverted yield curve, it was inverted, it was still inverted prior to Silicon Valley Bank, but you can see since Silicon Valley Bank had their deposits wiped out and closed, there were some serious drops in this yield curve. You can see the 2-year yield dropped 1%, Okay, so last meeting, we also told our clients that we were starting to extend duration on our bonds. When yields go down, the price of bonds go up. Okay, and you can see here that short end of the curve, yields didn't really drop all that much, but the longer ends of the curve were pretty significant in terms of their yield compression. Okay. The last thing I'll say, right, the Fed is still hiking rates, so you see the left side is still going up. The market is worried about the economy, so the long end is coming down a little bit. How do we get out of this situation? How do we start incentivizing banks to lend more? Eventually what happens is in a recession, the Fed cuts rates again. So if the Fed cuts rates in this example back to say 1% or 2%, and you have the 10-year treasury at 3.5 still, that again would positively slope the yield curve and incentivize the banks to lend more. And that's where, again, this happens in a recession, and then you eventually have stocks start to price in a recovery beyond that. So the Fed knows what they're doing. I think they're kind of showing their hand by forecasting negative GDP later this year. We know that Jerome Powell he's studied the 80s and Volcker very well. He really doesn't want inflation to come back. And the only way you can really permanently kill inflation is to hike a couple more times in the face of declining inflation and force ourselves into a recession here.
Right. No, those are all good points, and really goes to show why we started to increase duration during the year. I mean, it's helped defensively, grabbing on to those yields before the Fed compresses the yield curve back down. Can be rewarding for investors. We have someone who asked the question, are the low interest rates of 3%, et cetera, a thing of the past? Or do you guys see things revert back to those rates in the future, or probably not? We just see rates climbing and climbing.
That's a great question. I think they're probably referring to like mortgage rates of 3% of the past. I would guess not. I think we'll probably see that again. I think this is just like from the 80s until now, we saw rates go from like 10% down to 0. It was a 40-year process. And I would guess that there's going to be periods where the Fed will take rates probably pretty close to 0, maybe not go all the way to 0. But mortgages are much more based off the 10-year treasury, which would be indicative of more longer term growth and inflation expectations. So I think most people you ask today think the end of low rates is done. I would say it's probably a 50-50 chance we go there. I know this is sort of a non-answer, but at the end of the day, technology is such a deflationary force in our lives that, long-term inflation expectations could still be overstated, and we could still see pretty low rates just given the way our humanity is evolving.
Right. What's the Fed's long-term rate? Is it 2.5 or is it 3%?
We've got a slide there if you want to quickly flip to that one.
Oh, there you go.
Here we go. Their long-term is 2.5% Fed funds rate. So, I mean, look, that was their long-term forecast for pretty much ever, but we all know that they fluctuate a lot around that. So I would guess they'd go lower. In a recession, they will uninvert the yield curve. So if the 10 years at 3%, they'll go lower than that. If the 10 years at 4%, they might go to 3.5%, 3%. But the 10-year is really going to be the major determinant of your mortgage rates and long-term lending rates.
Right. So the Fed's been raising rates, right? And we're noticing things are starting to break, right? So that kind of brings us into this next topic here. And unless you were completely off the grid in March, I'm sure you've heard this story. On March 8th, Silicon Valley Bank announced it needed to sell securities to meet client withdrawals. And by doing so, they racked up a $1.8 billion loss. This created even more panic among their clients. And we know how this works, right? when people fear a bank run, they end up escalating a bank run in that they all flood to the bank to try to pull their money out at the same time. And the bank only has so much cash on hand to give out. And no one wants to be that last client out that can't get their money right away. And so that escalated. Just 2 days later, regulators come in and shut Silicon Valley Bank down. By then, the havoc was already stretching across the financial markets, leaving many people concerned about money held at other banks. Soon after, the regulators, out of fear of contagion, they decided to seize Signature Bank. Banks like First Republic saw their stock price cut in half. Credit Suisse, which had been in the headlines with issues for months before this announced, they now need to borrow 50 billion Swiss francs. Just turmoil, complete turmoil. When, after that, we start to, enter, I'm calling it the support phase for the purpose of this, where a few of the larger US banks decide they should help to try to calm the markets before this gets even further out of hand and becomes an issue for them. And so they come together to save First Republic. UBS ends up taking over Credit Suisse. New York Community Bancorp steps in to help Signature Bank. And to end March, we have a Fed meeting where the Fed is expected to raise interest rates further. And they're sitting there, they're watching this all unravel, knowing that their interest rate increases prior played a role in all of this turmoil. And so they end up announcing that they're only moving interest rates up 25 basis points instead of the 50 basis points the market was originally expecting. Adam, help me unpack this here. Should we be afraid of a 2007, 2008 type scenario?
No, not as far as it pertains to all of our clients having their money being at risk of loss. Okay, there are plenty of economic repercussions that could come of this, which we'll get into in a minute. But the important things to know are that the banks failed. Okay, they were not bailed out. I hate when people are saying, "Oh no, the banks got bailed out again." They did not. Depositors were made whole. Okay, the bank, if you own Silicon Valley Bank stock, it's a zero, right? Write it off as a loss because it's not coming back. But investors were made whole, or depositors, I should say, were made whole. And I think that's important for our clients to know that your assets are safe. Whether it's a big bank or a small regional bank or a credit union, your assets are going to be fine. There might be a small inconvenience of getting them out in the event of a bank run like this or a collapse like this. I would also say that there are probably going to be more banks that go under down the road because of the reasons why Silicon Valley Bank went under. And we're not going to get into it on this webinar. We've written several articles about what happened, why it happened, and how reckless we think some of the decision making was involved with Silicon Valley Bank and the other banks. So I would encourage you to go on our website, withumwealth.com, read some of the recent articles because there's a lot of great content we've pushed out recently about how this came to be and what actually happened. But what we will say is we want to talk about why this was idiosyncratic possibly and tied to Silicon Valley Bank. And I think it's also important to note the recklessness, at least in our view of the Fed, to continue hiking rates in the face of this. I mean, Powell during his press conference admittedly stated that this should tighten credit markets, okay? Banks should probably be less likely to make loans, like we talked about, because of the inverted yield curve, not just because of that inverted yield curve and it's less profitable for them, but for this reason, where if they know that the Fed's going to continue hiking rates and their loans of the past are underwater in some sense, they're going to stop making loans as the longer term rates have declined and they have to continue paying out CD rates that are not profitable for them. So this is kind of a problem for credit markets and that loan growth we talked about, which may have economic repercussions down the road. But I would say 99 out of 100 banks are okay in terms of their capitalization. It's really just this panic and fear that set in that forced the regulators' hands to be able to have an orderly dissolution of the banks rather than leave some people out high and dry while others pulled their funds. Okay.
And to your point, I think the Fed was sending a message with that 25 basis point rate hike, in that their goal is to break inflation's back, and they're willing to stay data dependent. They're willing to do that. I personally believe that the Fed is likely going to raise rates to above the inflation level, because historically, when you look back, that is often what it takes to break inflation. So, I mean, we'll see. Time will tell.
The last thing I would say is, if you do have excess cash in a bank, we've been telling our clients this, but for those that aren't clients, you can get very good yields in short-term, 3-month treasury bills, 6-month treasury bills. You can lock in close to 5% for the next year, right? So if you think the Fed is going to cut rates in the future, money market rates are about to start dropping too, as soon as they cut the rates. So talk to your advisor, or if you're not a client, give us a call. We can certainly talk to you about ways that you can be yielding more on your cash.
Right. To the extent you have excess cash, right? Why have it sit in the bank earning, nothing or very little, when you can go out to the treasury market, short-term treasuries, right, and earn, 5% just from there. And then also, it's state tax free. So, if you're a New Jersey resident, that's close to 6%, a 5% return, 6% equivalent. So, you really want to be conscious of that. You really want to be conscious of not holding too much cash at the bank, just from an FDIC insurance level. Let's skip to, these charts here. I remember when the news first came out of Silicon Valley Bank, our, analysts, our researchers, hit the Bloombergs, hit the Thomson terminals. What can we find? What happened with Silicon Bank? Can this happen? Will this happen to other banks? What's our exposure here? We really got on top of it. I remember looking at charts like this, maybe that day or the day after, where we really stayed on top of it. What are we looking at here?
Yeah, so the chart on the left is plotting a bunch of different banks and trying to measure whether their deposits are a flight risk or not, and also whether their loan to asset ratio is very high or very low, right? So if they have more loans compared to their asset base and the assets flee, then they have way more liabilities than assets, and that's not good. So they want to make money off by lending out the cash at higher rates, but you have to do this with balance. And so on the left chart here, the higher up a dot is, that is more retail deposit base, which retail clients, individuals like you and me, Austin, are much less likely to move around their money for incremental yield. We call those sticky deposits. Whereas if you're closer to the bottom of the list, one of the dots on the bottom there, you have a lot more institutional clients. So businesses where if they can earn an extra 0.0005% yield, they're going to move their account, because we're talking about most likely bigger dollar amounts, and it affects their bottom line, and they have that duty to shareholders to make more money, right? So you can see Silicon Valley Bank, the red dot there is sort of all the way down at the bottom and then pretty far to the right. So they lent out plus securities a lot relative to the assets they held, and that was to, again, earn money on the assets that they had to pay out yield on. But then also the fact that they were a majority of institutional clients meant that in the event something happened, they weren't offering the best rates, or something with the economy happened and they were forced to burn through their cash quicker, then they were highly at risk. And so the right chart, it explains just that. If we think back to 2022 and what got hit hardest in the market, it was tech stocks, right? It was those growth companies. It was the startups. It was sort of, we call them non-profitable tech, right? But like the ARC innovation type names, where they thrived on 0% interest rates and free money. But as soon as rates started going up, all of those companies had a really tough time. We've seen a lot of those types of companies start cutting jobs sooner than other more established technology firms. And what you can see on this right chart is that nearly 50%, if you want to highlight those right two charts there, nearly 50% of their clients were, yeah, the 29 and the 20. Yep, there you go. So,
Wow.
or just over 50%, I should say, were VC funded, early stage technology or tech companies, startups basically. And these were the companies that, in the high interest rate environment, and once they started seeing their business dry up, they just started burning through their cash. So you kind of had this perfect storm of why Silicon Valley Bank was the one bank that failed. This is going to get more into conspiracy theories, but Signature and Silvergate were the other two big name banks that failed, and those may have had some ulterior motives because they were very friendly in the crypto and digital asset space. So I know there's been a big regulatory push against that type of investment or asset. So, it's been rumored that Signature Bank, for example, was just fine from a capitalization standpoint. Barney Frank did a great podcast on the Daily that I'll shout out about that. But at any rate, Silicon Valley Bank is probably a little bit more idiosyncratic in this failure realm than anything that might signal failures with other banks to come.
I mean, even based on the characteristics on the left-hand chart, Silicon Valley Bank is really on an island by itself, right? And that was their risk that they took, right? It's argued that the depositors, shouldn't be at fault for that, but Silicon Valley Bank management certainly should be. So
yep.
Let's look at this chart here. Let me break this down really quick. So we have the gray bars going year by year. Those are the number of bank failures per year. So you'll note that a bank failure actually isn't that rare on a year-to-year basis. It happens more frequently than you may realize. This teal line that spikes up, that is the assets associated with the failed banks. So you'll see back in the 2008 financial crisis, we had those two major banks fail. That line spikes up. It spikes up again for the Silicon Valley Bank failure. And then in addition, we have a blue line that cuts through the chart. That is the closing price of the S&P 500 throughout that experience. Adam, can you break this down for us?
Yeah, so I think what happens is, and this is not to say we think what happened in 2008 will happen here, but we can maybe draw some parallels between the two. Okay, so in 2008, we know Bear Stearns and Lehman went under. They were two of the biggest banks at the time, and that's where you see the gray bar in 2008 is pretty short relative to 2009, 2010, 11, 12, etc. But the amount of assets that those two and several banks held that did fail in early 08 were relatively large, okay? And this started the banking crisis. These first few big banks that failed were the start of this crisis. That's what caused all the other banks to cease their lending, okay? Loan growth slowed, and then we had a recession. We didn't start the recession until 2009, right? Or late 2008. The market bottomed in early 2009, and you can see the market started a new bull market, March 9th, 2009, okay? That was the bottom. But all through 2009, 2010, 2011, 2012, even 2013 has had as many bank failures as 2008. So 4 years later, we still had as many banks fail as failed in 2008. But the assets of those banks that failed were so much less, okay? So what happened this year, we had 2023, we had 3 banks fail, and it was a lot of assets relative to, Silicon Valley Bank was a top 20 bank by assets, by deposit assets, okay? That's a serious thing. And this could cause lenders to tighten their belts a little bit, so to speak. And, the marginal loans that they would otherwise have given out, maybe they're going to think twice about that. That means less mortgages, means less lines of credit for businesses. etc. Eventually it leads to slower growth and possibly a recession. Now, I think the one caveat here is the market bottomed back in September of last year, right? We were down over 25% from the highs. This is going to be the most obvious recession. Whenever I see we had a question about, are we anticipating a summer recession? We don't know when it will start. Could be now, it could be the summer, it could be the fall, it could be 2024. It could be not at all, right? But when it happens, I think it will be the most obvious recession that everyone saw coming. So maybe that's why the market already bottomed. And I don't want to say that the market is destined for new lows. We shouldn't invest like the market is destined for new lows. But I think we would agree that if we have a recession, there could be more smaller regional bank failures in the years ahead, and there'll probably be less assets tied to those bank failures, a similar pattern to what we saw in 2008. And I think, again, it's, looking at this chart is great because 2009, the market was up over 30%, believe it or not. And that was such a bad year for the economy. So I think it's really important. I mean, horrible in terms of the financial crisis. Unemployment didn't peak up over 10% until midway through 2010. And the housing market didn't actually bottom until 2012. But at that point, the market had been rallying for 3 years. We weren't at all-time highs yet. So, but the market saw fantastic returns through 2009, 10, and the beginning of 11, and 2012 and 13 were great years. So, I think it's really important, going back to timing, talking about the recession, it's possible a recession's coming. It's possible the market's going to continue to be volatile, but letting that drive your investment decisions is a mistake in our view.
Right. If you had a crystal ball, right, back in 08, and it told you, hey, all this bad stuff is still yet to come, would you have invested in the stock market? Probably not. You probably would have said, you know what, I'm going to wait for that to play out, right? But meanwhile, the stock market, in reaction to all that news, is going up. And that's because it's not actually reacting to that news, right? It already priced the bottom in, and it's focusing what's going to happen next, right? And that can very well play out from here. It can, it doesn't have to, it can. But that's just an important lesson, that 2008 to even 2012 period there.
Yeah.
Yeah. So, things are starting to break. A recession probably around the corner, the timing of which, we don't know. What does that mean for stock investors?
So we focused a lot on the left side of this chart last time. So our viewers can go back and watch the recording if they want a refresher there. But essentially, stocks bottom before the economy. And the right chart is what we wanted to focus on here, again, as a reminder that after you have the first 2 negative quarters of GDP, so when you're in the recession, you're in the middle of the recession, the forward-looking returns are very good relative to the average return. And the reason, again, as you just highlighted, the market looks forward. It looks towards that recovery. So once we get confirmation that we're in the recession, that could be a really good thing for the stock market, okay? And, you can look here, the next year after we have 2 negative quarters of GDP, stocks are up on average 26% in that next year. Fantastic returns, almost double the average, more than double the average return.
Right. We can't be present, right? We got to be forward looking when investing in the market. All right. So we spent a fair amount of time talking about the US. I think we should also highlight international because they've really come out of the gates roaring this year. The major indices up around 10% for the quarter. Do you think we have a changing of the guard here?
I kind of hope so. And not because I'm fully invested in foreign stocks myself or anything like that. US stocks have done so well for so long, and it's rare that these trends go on forever. And this is just a great chart. So every purple highlighted bar, peak and valley that you see here is a period of foreign stocks performing better than US stocks. And every gray highlighted area of this chart you see is when US stocks do better. So you can go back to the 80s when Japan outperformed. They had an amazing surge in economic activity there. In the late 90s, we think of that as the tech bubble here in the United States, formation of Cisco and IBM and all those great companies that performed fantastically well. In the mid 2000s, this was the emerging markets drastically outperforming the US nearly 2-to-1 during that bull market. China growth was on a tear during that time period, right? That's when the BRIC nations became a term. And this last bull market, we saw, again, US big cap tech, Apple, Microsoft, Google, Amazon lead the way. And so what you'll notice, the very bottom right, you can circle that, is since the start of 2022, foreign stocks have outperformed. It's small, right? Only 6% over the last, 5 quarters. However, this could be a changing of the guard. So what does that mean for portfolios? We're not ready to stick our necks out and go, 50% of the portfolio in foreign stocks at this point in time. We're sticking with our comfortable diversified allocation. It's about 20 or so percent, 20 to 25% of client equities are invested in foreign stocks. We have been for some time waiting for this moment. So we think we're very primed and ready to take advantage should foreign stocks continue to do well. What's one of the major reasons for this occurring? It could be the US dollar that's been weakening. Okay, so with rates coming down here in the US, or anticipation of rates coming down here in the US, we're seeing that the gap in foreign rates versus ours shrink a little bit. It makes foreign currencies more valuable. Also, if foreign currencies become more valuable, the stock in those companies, the price can appreciate more in dollar terms. Okay, kind of a confusing concept, but we can call your advisor and we can explain and talk to you a little bit about that more. But right now, we're really doing a conscious effort of making sure our clients have the appropriate amount of foreign exposure in their portfolios because it's been outperforming for the last year plus.
Right. I think an easy way to look at it is when you make an international investment, you're investing in both the company and then the currency related to that company. So if the currency related to that company does well, that's going to create a tailwind for that investment. If the company does well, obviously that's going to create a tailwind for your stock position. So when those are at conflict, it's whichever's stronger really. But we are seeing international perk up a bit. And what's interesting is when you look at when US started to outperform, that's back when easy monetary policy started. And what are we seeing now? We're seeing that get pulled back, right? We're seeing M2 come down. We're seeing interest rates going up. Do we need to see a reversal in this? No, but it is something that we're keeping an eye on. So we
had a question come in about the recession that we're expecting. Is it shallow? Is it brief? Is it deep? Is it long? What are we kind of thinking there? Maybe, I know we don't have a forecast, but what would you say the market is forecasting, Austin?
So based on how the market's pricing everything in, it looks like we're pricing in more of a shallow recession. At one point before Silicon Valley Bank, I'd say that the market was starting to look like it was pricing in no recession. I don't know that we were ever in that camp ourselves, but it would appear that the market's pricing in a shallow recession at this point.
I would agree. I think it's important to remember that the market moves based on the difference between what people expect, or what everyone in the market expects, and what the reality actually happens. Okay. If the reality is there's no recession and people are expecting a mild recession, that could be a really big tailwind and a good thing for stocks. On the contrary, if the market is expecting a mild recession, I don't know, 4.5%, 5.5% unemployment, and we get like 6.5%, 7% unemployment and a deeper recession than expected, that might not be a good thing for stocks. So this is something we're going to keep our eyes on. We'll kind of dovetail this with the economy has been much more resilient all through this last year in the face of high inflation, in the face of 5% worth of rate cuts in the last year up to this point. It wouldn't shock us if it continued to be resilient for a couple more quarters. But we think that the Fed's ultimate goal is to have some sort of uptick in unemployment, which should probably lead to a technical recession.
Right. So, and thanks for catching that. I missed that in the queue there. So let me forward on to this slide here. And, we talked about several scary items today, right? And in times like we're in now, investors may feel compelled to try to time the markets. And that makes sense because as humans, we are wired to feel a need to try to take control of things, especially things we identify as dangerous to us. But this is exactly what Finance 101 tells us not to do. In the late 1980s, a researcher by the name of Gary Brinson, along with two famed researchers, Hood and Biebauer, they set out to understand what are the main components in portfolio management that drive performance. And that's what we're looking at right now. They collected data on major funds, so the big players at the time. I think it was right around 100 of them, and used a regression analysis to understand what contributes most to how those portfolios moved. And the results are what we're looking at on the screen. What they found was that market timing, which a lot of retail investors spend a lot of time trying to get just right, was responsible for just under 2% of why those portfolios moved the way they did. And that's really nothing in the grand scheme of things. What interests me even more is that, we have all these ways of manipulating a portfolio, between market timing and security selection and factor analysis, this and that. But the one decision that really matters the most, that impacts a portfolio's movements the most, tends to be that one area that the retail investor doesn't pay as much attention to, and that is asset allocation. How much do we have in stocks versus alternatives versus bonds? That's really what investors should be paying attention to, because it is the catalyst of over 90% of the portfolio's movements.
Right. I think it becomes really frustrating to see CNBC all day long talk about, grade this trade. What are you trading today? It's just not how you make money as an investor. Some people can, but to try your luck, and I use that term specifically, luck, at trying to time the market is just, you're going to get it wrong at some point. And when you do, what this study tells us is you're much better off just picking the right asset allocation for your goals and your objectives and what kind of return you need than trying to worry about market timing. I would much rather invest at the top, but pick stocks and bonds and not pick, cash or oil to invest in, right? I mean, that's what we're talking about here, is different asset classes. So making sure that you're in the right types of investments, not caring what the timing of those investments and putting the money to work is just so overwhelmingly paramount, as this shows. And then, there's little slivers of, okay, within stocks, do we choose tech stocks, or do we choose energy stocks or consumer stocks? That does affect our returns over time, but not nearly as much as saying, should we be in stocks or should we be in cash?
Right.
And then we have, beyond that, okay, we've decided to be in energy stocks. Do we pick Chevron or Exxon? That's like, the little icing on the top. And then the sprinkles are the market timing question. So really interesting study. And I think it just goes back to several times we've talked about it. The first slide, timing the recession. Just don't worry about the market timing. The market's going to do what the market's going to do. Make sure you're sticking to your plan that you've worked through with your advisor, and revisit that plan, check up on the progress of that plan from time to time, and you're going to be successful.
Right. And, just to piggyback off of this, when you look at other studies along with the Brinson study, market timing is probably a bigger risk to your financial success than a benefit. What we're looking at now covers 10 years, a decade of performance. That amounts to about 2,500 trading days. If you happen to have missed just the 10 best trading days in the market over this time period, your return relative to staying fully invested all the time would be reduced by over 30%. Just missing 10 solid days over 2,500 days, you may have missed over 30% of upside. You know, why risk it, right?
The incremental benefit for getting the timing right is so minimal compared to what you miss out on if you get the timing wrong. It's just, there's been plenty of studies about this, and I think that highlights the importance of an advisor's role. And I say advisor because whether it's us, whether you have multiple advisors, the number one thing your advisor should be good at is counseling you through those really tough times. And this is just the perfect example why. If you think back to COVID, I mean, the market was going up and down 5 to 10% in a day. And market circuit breakers, right? Like the market was being halted because it was so volatile. But there were some very good days mixed into those very bad days. And the first 2 days off the bottom were up over like 12%, I believe, after the market actually fell down and started its recovery. So if you miss that initial 10% jump off the bottom, you know, you didn't double your return over the next year. You were like 70% of your return. And I think that's just so amazing to see. You know, you can see it here on the chart, the growth of $1,000. It goes from almost three grand to $2,000, right? That's a third of your return just for missing just 10 days. It's absolutely fascinating that, you know, being off on your timing can have that big of an impact.
And what you're talking about that happened during COVID is not uncommon. If you look at this data set, you know, the majority of those 10 best days occurred within only 2 weeks of the 10 worst days. And that's nothing. That's 2 weeks. That's 10 trading days. So within, right after those 10 worst days, we had somewhere within 10 days, most of the 10 best days. You know, you can't expect to get that timing right and perfect. That it's just incredibly difficult.
No, you need to get 2 timing iterations correct, right? You have to get out of the market at the right time, and you have to get back into the market at the right time. And if you're dealing with capital gains, you know, you better hope that drop is big enough to make up for the taxes you're going to pay if you're realizing gains. So
right.
I think this is a great.
Being able to weather those 10 worst days is worth it because it allows you to participate in the 10 best days. As you can see, you know, by the bar all the way to the left, you know, this captures the worst and the best days, right? Right. If you're able to weather the worst days, you can grab hold of the best days, and that helps.
Just going full circle here before we wrap up, just pretend you're dead, right? If you're dead, you can't sell anything. You can't get worried. So no, but it's really a great message here, especially if the economy is going to get dicey. Doesn't mean the stock market will, but it's worth reiterating time and time again.
Sure. So we have 2 additional questions. What is, you know, your forecast on the economic risk pertaining to the China-U.S. geopolitical issues looming for this year and next? I can take that one.
Sure.
We also have a question on the impact if the federal debt ceiling is not raised. So let me talk
just before we dive into that, for those that need to jump to another call or meeting or get on with their days, thank you all again for attending and listening. This is the second iteration of these types of economic webinars we've done. It's meant to complement our quarterly letter, but we are really looking for feedback from each and every one of you on how these are going. Talk to your advisor or fill out the survey that you'll be seeing shortly. It has some questions. We want to hear from you about topics for the future. If you like more of the short-term stuff, the long-term stuff, if you like this method of communication better than the quarterly letters, or you like reading both and seeing both. So please do take some time put some thought into that, and we'll get on here with some of the questions.
Sure. That's a good point. Thanks. And thank you everyone who attended. So regarding the China-US political tensions, the economic risks, they're significant. They could potentially have a negative impact on the global economy. As it is, the ongoing trade tensions and tariffs imposed by both countries have already affected the global supply chain and caused disruptions in international trade, right? That's just the fact of the matter. But I think if we back up a bit, will the global stock market fall off a cliff in the coming 12 to 24 months because the US and China are throwing jabs at each other? Will we see a major bear market because of this? I would say most likely not. A more probable outcome would be a reduction in positive returns, a headwind that keeps an already growing economy from growing as fast as it could if everyone played nice in the sandbox. I mean, when you look at what China has to offer the economy, both as a provider and a consumer, it's a large amount. When you look at the US, same thing. So you take two big parties like that and have them not play well in the sandbox, that's going to create some headwinds. Is it a reason to stay out of the market? I don't think so, because I think there still can be positive returns even in that climate. So I would encourage, investors not to try to be in or out because of this, but just to understand, what are the repercussions when, two big parties don't work nicely together. And then eventually, hopefully, whether it's in a year, whether it's in 10 years or 20 years, those tensions hopefully go down. The US ends up working better with China, and hopefully that would then create a catch-up environment with the market where we see an acceleration of returns.
I would just say everything's probably priced in that we're all worried about, right? So what happens if you have to assign probabilities to those possibilities? So let's say there's a 50% chance of something bad happening. If there's a 50% chance of something good happening and something good happens, like there's some sort of resolution, that could send emerging market stocks through the moon, or US companies that deal a lot with China through the moon, right? So there's, again, going back to the fear aspect of this, it's very easy to gravitate towards what could happen and what's really scary, but that doesn't mean it's more likely, right? Or even if it does happen, it's not something we can control as investors. We just have to structure our portfolios properly to account for those possibilities.
Right. Great. So you want to go take this one by the horns here? Please address the potential impact if the federal debt ceiling is not raised.
Yes. So this is going to become more and more of a talking point across the media. At this point, I don't think a recession would be caused because of us tapping out the federal debt ceiling. I think it's important to note that debt will be able to be renewed. It's not like we can't issue any more debt. If debt comes due, we can reissue up to that cap, right? We have some flexibility there. There are mechanisms that the government has to slow or stop spending money in certain areas to ensure that the essential parts of our country continue functioning. I believe this happened a couple of years ago, or maybe 5 or so years ago, where a lot of government employees were furloughed for a period of months, right? It probably wouldn't help the economy, right? But I think regardless of the government shutting down to some degree or certain areas of the government slowing their business practices, it would just add fuel to the fire that's already kind of taking place under the surface. There's been I've heard some rumors and read an article that it was debatably unconstitutional to fail on our debt. So what happens in the past is probably what's going to happen this time. They'll kick the can down the road, leave it for the next election cycle so they can go back, politicians can go back to their constituents and say, look, we deferred this issue. You should vote me back in again so I can set the record straight. I think that's probably the most likely scenario here to happen.
Right. Again, short-term volatility, should be expected. Should the debt ceiling, should we not reach an agreement there? However, that should play little impact in, 1 year, 2 year, 3 year returns. That's, historically speaking, a month, a handful of months, if anything, that would cause that volatility.
The biggest indicator would probably be treasury yields. So if there was an actual risk that we would default on our debt, you would start to see treasury yields spike. And we haven't really seen that at all. So something to keep in mind, but it's more of I would say that's more noise than actual news.
Great. Well, we just passed 3 o'clock, and I know we promised everyone 3, so let's end it here. Thank you again for tuning in. We appreciate your support. We also appreciate your feedback. So, please reach out, let us know, if you have any comments, questions, or anything like that.
Thanks, Austin.
Thanks.